The most dangerous kind of sell-off just happened. Everything fell at once. The Philadelphia Semiconductor Index dropped almost 8% in a single day, and at the very same time, gold broke below $4,000 for the first time since November, the safe haven crashing right alongside the risk asset. Silver fell 5%, both crudes dropped, Bitcoin slid under 63,000. When the haven sells on the same ticket as the stock, you are not watching a rotation. You are watching a margin call. Someone somewhere is being forced to raise cash. And tonight, the whole argument gets a verdict. Micron reports after the close, the cleanest read on the one question this entire sell-off is really asking: is the artificial intelligence build actually earning its return? Wall Street expects about $35.5 billion of revenue, up nearly 283% in a year, at a record gross margin near 82%, with 2026 memory already sold out. The options market is bracing for a 13% move. This one print moves the entire trade. So where's the edge in a margin call? You find out who actually prints cash. Not the leveraged proxy strategy just fell below $100 for the first time in over 2 years. The discipline owns the input that funds itself. Micron's own filings already show it. Half a year of revenue, $37.5 billion, has already matched an entire prior year, and its memory is sold out. The crowd is selling everything. The discipline owns the cash flow. This is the asymmetric. Issue 26. The margin call, tech and crypto investing for thoughtful retail from an operator's lens. Issue 25 was the most crowded trade resetting, and its tell was rotation, not flights. Small caps held while the chip beta flushed. This issue is what happened next, and it changes the character of the move. The reset stopped being selective. The selling went everything at once, and in a liquidation, you find out who actually prints cash. Here's the one-line read. The artificial intelligence reset became a margin call. The selling went synchronized. The semiconductor index fell almost 8% in a session, with Nvidia down 4%, while gold broke below $4,000 for the first time since November. Silver fell about 5%, both crudes dropped over 4%, and Bitcoin slipped under 63,000 with strategy below $100, its lowest in over 2 years. When the haven sells on the same ticket as the risk asset, that is forced de-risking, not rotation. The accelerants, a hawkish Federal Reserve, the market now prices for about 2 more hikes this year, and the loss of the Iran war premium after a 60-day Iranian oil license drained the bid from oil and gold together. The bull rebuttal, an earnings-led third-inning pullback, not a bubble bursting, is credible. But it now has a dated test. Micron reports tonight. The discipline that survives a margin call own the self-funding profit and the scarce, sold-out input, not the leveraged proxy. You'll see the same labels throughout. Confidence, high, medium, or low. Consensus versus variant, what the market believes and where we may differ. And on every call, what would change our mind. That's the discipline. Part 1. The macro regime. The reset metastasizes into a margin call. The 30-second frame. 1. The sell-off went synchronized. The semiconductor index fell almost 8% in one session. The Nasdaq Composite down over 2%, while gold, silver, both crudes and crypto all fell at the same time. 2. Gold cracked $4,000, the first time since November, now roughly 25% below its January peak. The haven sold with the risk asset. 3. The driver flipped hawkish. The market now prices about 2 more hikes this year, with Bank of America calling for 3, and the 30-year yield fell to its lowest since mid-April. 4. The war premium died. The United States and Iran de-escalation, plus a 60-day Iranian oil license, drained the bid from oil and gold together. And 5. The verdict is dated. Micron reports tonight, the cleanest test of whether the build earns its return. Start with the signature of the move. The Philadelphia Semiconductor Index fell 7.9% in a single session, Nvidia down 4%, and Intel, Marvell and Advanced Micro Devices down between roughly 6 and 9%. Samsung and SK Hynix each about 12%. The Nasdaq Composite fell over 2%, the broad market about 1.5%. The Dow held, and the volatility index sat near 19.5, orderly. Not panic, but the distinguishing fact is not the size of the equity move. It is that gold, silver, both crudes and crypto fell on the same day. When the haven and the risk assets sell together, it is not sector rotation, last issue's read, which held that day. It is portfolio-wide de-risking. Someone is raising cash. In a margin call, quality and junk both sell first, then quality recovers and junk does not. Now the clearest tell, gold. Spot gold broke below $4,000 for the first time since November, trading near $3,968, now roughly 25% below its January peak. Silver fell about 5%, both crudes over 4%. Goldman cut its year-end gold target to $4,900. Deutsche Bank cut its third-quarter target to $4,300. Two forces hit it at once. The hawkish Federal Reserve repricing lifted real yields, and the dollar gold pays no coupon, so it loses to cash when rates rise, and the de-escalation with Iran drained the geopolitical premium. But the tell is the timing. Gold did not sell because its structural case broke. It sold because it is liquid and held a gain, so it was the asset investors could sell to raise cash. The structural bid is intact. The near-term tape is hostage to the dollar and real yields. What made the selling cross-asset? Two things. The Federal Reserve path flipped hawkish. The market now prices roughly 2 more hikes this year. Bank of America calls for 3, and the 30-year yield fell to 4.86%, its lowest since mid-April, a hawkish flattening. And the war premium drained, a Treasury 60-day Iranian oil license, plus the de-escalation, took the bid out of oil, now around $72 to $74, and out of gold at once. China's crude imports are down about 40% as electric vehicle share surges, possibly structural demand destruction. Here's why it's synchronized. A hawkish central bank raises the opportunity cost of every non-yielding and leveraged asset at the same time: gold, long-duration tech, crypto proxies, which is precisely the set that's sold together. The macro tail everyone names is a 5% 10-year. Part 2, in focus, the gut check on whether the build pays. Micron, the whole reset reduces to one question: is the money pouring into artificial intelligence infrastructure earning a return? Micron is the cleanest listed instrument to answer it, and its filings already show the demand. The half-year ended February 2026 produced $37.5 billion of revenue, essentially all of fiscal 2025's $37.4 billion full-year revenue in just 2 quarters. The February quarter alone was $23.9 billion versus $8 billion a year earlier. For scale, fiscal 2024 revenue was $25 billion. This is the audited curve, not a forward slide. And tonight, after the close, Micron reports its third quarter. Consensus near $35.5 billion of revenue, a record gross margin around 82%, with 2026 high-bandwidth memory already sold out. And the options market pricing a 13% move. Now the mechanism, and in a margin call, it is the whole game. The question is, does the build earn its return? Micron's answer has 3 parts. First, its entire 2026 high-bandwidth memory supply is already sold out, so its print is a near real-time read on artificial intelligence data center demand and on whether pricing is holding. Second, the margin, a record near 82% on consensus, reflects a genuine mix shift toward high-value memory and customer lock-ins, not a generic commodity upcycle. If those margins sustain, the business earns a growth multiple, not a cyclical one. Third, it is a dated, falsifiable test. It reports tonight. The contrast: Micron prints its own cash and is sold out, the opposite of the leveraged proxy a margin call punishes. Like strategy under $100 or SpaceX issuing into negative cash flow. In a forced sell-off, the cash generator is the one that recovers. The one risk no self-funder escapes in memory is the cycle. The debate, the bull in the numbers, a self-funding profit engine at the scarce point of the build, memory sold out for the year, a record gross margin reflecting a mix shift to high-value memory and customer lock-ins, and an audited revenue curve where half a year already matched a full prior year. If 80+% margins sustain, it deserves a growth multiple. In a margin call, this is the name the discipline keeps. It generates the cash rather than borrowing it. The bear and the iron law of memory. Margins this high have always attracted capacity. SK Hynix is reportedly filing a $29 billion listing to add it. A memory stock at a record margin, up over 700% in a year, is priced for the upcycle to persist, and the whole sector just fell 8% in a session on exactly the fear that returns won't justify the spend. The third inning could instead be the late innings. Tonight's print and guidance are the referee. The read, a research view, not a call. Micron is the cleanest listed test of whether the build earns its return on the eve of its verdict, and the filings make the demand concrete. Half-year revenue of $37.5 billion, the February quarter nearly triple its year-ago level, against $37.4 billion for all of last year. It prints its own cash and is sold out for the year, the opposite of the leveraged proxy the margin call punishes. But it carries the one risk no self-funder escapes in memory, the cycle. What would change the read? A print that shows memory share expanding and pricing holding, with margins sustained, the bull, re-rate to a growth multiple versus any sign of pricing rolling over, guidance that implies the industry is about to add supply or a margin miss, the bear. The cycle is turning and the multiple compresses. The countercurrent, while Micron's business prints cash, the leveraged proxy is where the margin call concentrated. Strategy fell below $100 for the first time in over 2 years as Bitcoin slid under 63,000 and Ether towards 1,700. The crypto treasury lever, borrowing or issuing to hold coins, is the reflexive trade that deleverages hardest when liquidity tightens. But notice what happened underneath the price bleed. The plumbing kept institutionalizing. The first onshore United States Bitcoin perpetual futures went live. One venue did about $1 billion in week 1, and BlackRock formally recommended a 1 to 2% Bitcoin allocation for institutional portfolios. So the structure is bullish long-term, even as the leveraged proxy takes the pain. The lesson of a margin call is the lesson of the laid. Own the asset that funds itself. Avoid the one that needs the financing window open. And the thematic. A margin call is a test of who actually prints cash. The fear driving the reset is now explicit and dated. Billions committed to artificial intelligence infrastructure have outrun clear, audited evidence. The products earn returns that justify the spend. And tonight, a marquee name reports into that exact question. A margin call strips the market to one distinction: businesses that generate cash versus claims that consume it. So reward the self-funding profit at the scarce point. Sold-out memory, the cash-generative hyperscaler, the toll booth that already prints, nuclear baseload and the gas that feeds it. Be wary of the borrow-to-build and the reflexive lever, the debt-funded build and the crypto treasury proxy. The layers a rising rate and a margin call punish first. When forced selling hits, both sell. When it passes, only the cash generators recover. Part 3, the margin call, own what prints its own cash. What we are watching over the next 10 days. Micron's third quarter earnings tonight, the gut check on memory pricing, margins and guidance. The personal consumption inflation print this week, hot deepens the de-risking, soft lets the dip buy hold. Whether the cross-asset selling spreads to a volatility spike, calm near 19.5 today, a break above the mid-20s would signal forced deleveraging. Whether gold holds near 3950 to 4,000. The United States and Iran's 60-day follow-through, SpaceX short interest, the Federal Reserve path, strategy below $100, China's crude imports and electric vehicle share, and whether the small-cap breadth of last issue survives a synchronized liquidation. And we keep score in public. Micron enters as the lead self-funding profit and scarce input name, own the sold-out input that prints its own cash, respect the memory cycle, the artificial intelligence margin call, the reset became forced de-risking, gold constructive structurally pressed near-term, Alphabet the self-funding compounder, strategy avoid the reflexive lever, Nvidia the self-funding toll booth, Constellation, Talon and EQT, the power layer, Oracle and SpaceX, the borrow to build, Bitcoin and the crypto rails, a liquidity tape over institutionalizing structure, and oil with the war premium gone, dated, falsifiable calls, and we grade them. So where does it land? The artificial intelligence reset became a margin call, and the Federal Reserve plus the dead war premium are the cause. The selling went synchronized. Semiconductors down almost 8% in a session while gold broke below $4,000, silver, oil and crypto all falling together. When the haven sells with the risk asset, that is forced de-risking, not rotation. The bull rebuttal is credible, an earnings-led pullback. Not a bubble bursting, but it now has a dated test. Micron reports tonight. The discipline that survives a margin call is to own what prints its own cash. Micron's filings already show the demand, half a year of revenue matching a full prior year, with memory sold out, while the leveraged proxy is the pain point. The crowd is selling everything. The discipline owns the cash flow. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.